The drought came to Champaign County, Illinois, in the summer of 2012, the way all great droughts come, not suddenly, but through the slow, merciless accumulation of days without rain, each one compounding the damage of the one before it. By early June, when corn plants should have been knee-high and thriving, farmers were already watching their fields turn brittle and pale. By mid-July, when temperatures in central Illinois exceeded 100 degrees for 7 consecutive days, the corn crop that had been planted with high expectations in April was visibly failing across thousands of acres. The numbers told the story with brutal clarity. Champaign County, one of the most productive agricultural regions in the United States, had planted 288,000 acres of corn in the spring of 2012. Under normal conditions, the county's average yield was approximately 173 bushels per acre. By harvest that autumn, the actual yield would be 108.9 bushels per acre, a loss of 64 bushels per acre, a 37% reduction, the worst drought year performance since 1988. Across the United States, corn yields fell by more than 40% in the most severely affected regions. The national average corn yield dropped to 123.1 bushels per acre, down from 146.8 bushels the previous year. The commodity markets responded exactly as they always do. When supply contracts sharply, prices spiked. Corn futures on the Chicago Board of Trade, which had been trading near $5.50 per bushel in early June, surged past $7 by mid-July and peaked at $8.24 on August 10, 2012. This was not quite a record. The all-time high of $8.43 had been reached briefly in June 2011. But it was close, and for farmers watching their physical crops wither in the fields, the rising futures price was the only good news in an otherwise catastrophic season. In Champaign County that summer, nearly every grain farmer made the same decision. They locked in the high futures price by selling forward contracts. Some sold directly to elevators through hedge to arrive contracts. Others sold futures contracts on the Chicago Board of Trade. The logic was straightforward and professionally endorsed by commodity brokers, agricultural economists, and university extension specialists, with physical yields down 37% and prices up 50% from June levels. The prudent strategy was to capture the price spike by selling forward. The crop might be small, but at $8 per bushel, the revenue per acre could still approach historical averages if a farmer acted quickly. Frank Obermeyer, 75 years old that summer, did not sell a single forward contract. He did not sell to the local elevator. He did not sell futures on the Chicago Board of Trade. He did not lock in the $8.24 peak or any price near it. Instead, he watched his 1,200-acre corn crop mature slowly under the punishing heat, harvested it in late October at a yield of 94 bushels per acre, worse than the county average, and moved it directly from the combine into the wooden grain bins he had built with his father in 1967. Frank Obermeyer had no intention of selling anything until the price was right, and in October 2012, despite the drought year spike, he did not believe the price was right. What Frank believed, and what his father Carl had taught him during the farm crisis of the 1930s, was that a farmer who sells his commodity before the harvest is finished is a man betting with someone else's sweat. The grain bin, Carl Obermeyer used to say, is a bank with no interest rate and no possibility of bankruptcy. When you hold physical grain in storage, you are not speculating. You are waiting for the market to meet your price, not forcing yourself to meet the market's timing. This philosophy was not popular in Champaign County in the autumn of 2012, but it would prove, over the following 6 months, to be worth 23% more per bushel than the strategy adopted by nearly every other farmer in the county. Carl Obermeyer had farmed in Champaign County since 1928, when he was 22 years old and land was still affordable for a young man with a strong back and a willingness to work from dawn until dark. He had survived the agricultural collapse of the 1930s, not easily, not comfortably, but survived nonetheless, And the lessons he had learned during those years shaped everything he taught his son Frank about commodity risk. The central lesson was this: price volatility in agricultural markets is driven by perception of scarcity, and perception of scarcity changes faster than actual scarcity. In a drought year, prices spike early because buyers panic. But droughts end, and when they do, the panic fades, and prices fall, often sharply, often quickly. If a farmer sells at the peak of the panic, he captures a high price, but loses the opportunity to sell into the recovery, which can be slower, steadier, and ultimately more profitable for those with the patience and the storage capacity to wait. Carl had learned this in 1934, when a severe drought across the Midwest sent corn prices surging in midsummer. Neighbors sold forward contracts at what looked like excellent prices. Carl held his grain in wooden bins he had built himself, waiting. By the following spring, when the panic had subsided but supplies were still constrained, Carl sold his 1934 corn at a price 19% higher than the peak his neighbors had locked in. Frank, born in 1937, grew up hearing this story. He heard it again in 1947, after another drought year when Carl repeated the strategy with similar results. He heard it a third time in 1955, when Carl explained to Frank, then 18 years old and helping full-time on the farm, that the principle applied not just to drought years but to any year when the market was driven more by emotion than by arithmetic. Markets, Carl said, sitting at the kitchen table with a pencil and the back of an envelope, on which he had sketched a simple supply and demand graph, are made by two kinds of people: people who grow things and people who trade things. The people who trade things react faster. They overreact up and they overreact down. If you have storage, you can wait for the overreaction to pass. If you do not have storage, you are forced to sell when the traders say sell. That is the definition of being powerless. Frank absorbed this lesson completely. In 1967, when Carl was 61 years old and Frank was 30, they built the grain bin complex that would define the Obermeyer farm's operating philosophy for the next half-century. It consisted of 4 wooden bins, each with a capacity of approximately 30,000 bushels, constructed from locally milled oak and pine with conical steel roofs and ventilation systems designed to keep grain dry and cool through an Illinois winter. The total capacity was 120,000 bushels, enough to hold the entire annual corn harvest from 800 acres at a normal yield of 150 bushels per acre. The bins cost $14,200 to build in 1967, a significant sum, nearly 20% of the farm's gross annual revenue that year. Carl Obermeyer paid cash. He did not borrow. He built the bins because he understood that storage was not an expense. Storage was freedom. By 1972, when Carl died at 66 from heart failure, Frank had already internalized the storage philosophy so completely that he never considered selling it. Over the next 40 years, Frank Obermeyer farmed 1,200 acres, expanded the storage capacity to 180,000 bushels by adding 2 additional bins in 1989, and never once sold a forward contract or a futures hedge. He harvested his corn each autumn, moved it into the bins, and sold it, all of it or portions of it, when local cash prices reached the level Frank had calculated he needed to meet his operating costs, debt service, and a reasonable profit margin. Some years he sold in November. Some years he sold in March. In 1993, he held corn until July and sold it 31% above the November harvest price. The strategy was not complicated. It was not exotic. It was the agricultural equivalent of refusing to panic, and it required 2 things: adequate storage capacity and a willingness to live with the uncertainty that comes from not knowing exactly when you will be paid. Frank Obermeyer had both. Phil Garrison came to Champaign County in March 2011 as a commodity broker for Cargill, one of the largest agricultural trading companies in the world. He was 40 years old, held a Master of Business Administration from Northwestern University, and had spent 12 years in agricultural commodity risk management, advising farmers on hedging strategies, forward contracting, and the use of derivatives to manage price volatility. Phil was good at his job by the standards of his industry. He understood the mechanics of futures markets. He could explain basis, carry, convergence, and the relationship between spot and forward prices with fluency and confidence. He had helped dozens of farmers structure hedging programs that protected them from downside price risk, while preserving some upside opportunity through flexible contracts and option strategies. In the summer of 2012, as drought conditions worsened and corn prices surged past $8 per bushel, Phil Garrison worked 14-hour days, advising Champaign County farmers to lock in forward sales. The recommendation was straightforward and consistent with every textbook and professional guideline in agricultural finance. With prices at near record highs and physical yields collapsing, selling forward contracts was the only rational response. Prices could go higher, but they could also fall sharply if weather improved or if demand destruction occurred as livestock producers culled herds in response to high feed costs. The prudent strategy was to lock in a known high price rather than gamble on an unknown future. Between June and September 2012, Phil Garrison arranged forward contracts for 23 farm operations in Champaign County, representing approximately 68,000 acres of corn. The average contract price was $7.85 per bushel. Phil's clients were pleased. Several thanked him personally. One sent a case of wine. The consensus among Champaign County grain farmers that autumn was that Phil Garrison had helped them navigate the worst drought in a generation and come out with revenue that, despite the yield losses, was not catastrophic. Frank Obermeyer was not one of Phil Garrison's clients. Phil had visited the Obermeyer farm in April 2012, a routine prospecting call, part of Cargill's outreach to all significant acreage holders in the county. Frank had listened politely to Phil's pitch about risk management and forward pricing strategies, asked a few questions about how Cargill set its basis and what the company's margin structure looked like, and then said, in a tone that was not confrontational but left no room for negotiation, that he appreciated Phil's time but that he did not sell forward contracts. Phil had asked why. Frank had walked Phil out to the grain bins behind the farmhouse and said, "Because I already have a risk management strategy. It is called storage." Phil had smiled at this, the kind of smile a professional gives to a well-meaning amateur who does not fully understand the complexity of modern commodity markets. He had thanked Frank for his time, left a business card, and made a note in his client management software that Frank Obermeyer was not a prospect. That note would look different by the spring of 2013. The harvest of 2012 in Champaign County was brutal and brief. Yields were down by more than 1/3. Corn that normally stood tall and green well into October was desiccated and stunted by mid-September. Combines rolled early, and by November most of the county's crop was either sold or sitting in commercial elevator storage. Frank Obermeyer's 1,200 acres yielded 94 bushels per acre, 112,800 bushels total. He harvested it in late October, moved it directly into his bins, and sealed the bins for winter storage. The cost of holding the grain, electricity for ventilation fans, a small amount of propane for drying, and the opportunity cost of not having immediate cash was approximately 23 cents per bushel per month. In November 2012, the local cash price for corn in Champaign County was $7.42 per bushel. Frank did not sell. In December, the price was $7.28. Frank did not sell. In January 2013, as new crop planting intentions began to circulate and traders started to anticipate a return to normal yields, the price dropped to $7.05. Frank did not sell. The farmers who had sold forward contracts at $7.85 watched these price declines with relief. They had locked in a high price and avoided the post-harvest drop that historically follows drought year spikes. Phil Garrison's advice had proven sound. The market was behaving exactly as expected. but the market was not finished behaving. In February 2013, two things happened that would reshape the price trajectory for old crop corn. First, the United States Department of Agriculture released export data showing that United States corn shipments remained weak, down 18% year-over-year, despite the high domestic price, because global buyers had shifted to alternative suppliers in South America and Ukraine. This suggested that the United States corn supply, though small, had not been fully rationed. Second, ethanol production, which had been reduced sharply in the first half of the marketing year due to high corn costs, began to rebound as gasoline demand recovered and ethanol margins improved. These two factors, weak exports but rising domestic ethanol demand, created an unusual market dynamic. The total supply of 2012 crop corn was indeed constrained by the drought, but the pace at which it was being consumed was slower than initially projected. This meant that old crop supplies would not run out before the 2013 harvest arrived. But it also meant that anyone holding old crop corn in storage could sell into a market that was still tight, still offering a premium over new crop prices, and still offering carry, the price incentive for storage, at levels that made holding grain profitable. By March 2013, the July 2013 corn futures contract, representing old crop corn, the stuff already in storage, was trading at $6.50 per bushel. This was well below the August 2012 peak of $8.24, but it was still significantly above the pre-drought level. More importantly, because of the inverted futures curve and strong local basis, spot cash prices in Champaign County were trading at $6.85 to $7.10, depending on the buyer and the week. Frank Obermeyer sold 40,000 bushels in March at $7.05 per bushel. In April, local cash prices firmed further as ethanol production continued to accelerate and as some commercial elevators ran low on inventory. Frank sold another 35,000 bushels at $7.22. In May, the cash price in Champaign County briefly touched $7.48 as basis strengthened ahead of the United States Department of Agriculture June 1st stocks report, which was expected to show that old crop corn supplies had been drawn down more aggressively than earlier estimates suggested. Frank sold his final 37,800 bushels at $7.44. The weighted average price for Frank Obermeyer's 2012 corn crop, sold between March and May 2013, was $7.25 per bushel. The average forward contract price locked in by Phil Garrison's clients between June and September 2012 had been $7.85 per bushel, but that was the futures price. By the time basis was applied at harvest, the effective cash price received by those farmers was approximately $7.42 per bushel. Frank Obermeyer's average sale price of $7.25 was 17 cents per bushel lower than the $7.42 his neighbors had received at harvest. But Frank Obermeyer had also captured 8 months of storage carry. And more importantly, Frank had sold into the spring recovery, a recovery that futures sellers, having already committed their grain at harvest, could not access. When basis and timing were fully accounted for, Frank's net realized revenue per bushel, after deducting storage costs of 23 cents per bushel per month for an average of 5 months, a total of $1.15, was $6.10 per bushel. The farmers who had sold forward at harvest received $7.42 at the time of sale, but they also paid commercial storage fees for those who used elevators or gave up the opportunity to participate in the spring rally for those who sold futures. The final calculation was more complex than a simple price comparison, but the conclusion was unambiguous. Frank Obermeyer's physical storage strategy, combined with his willingness to hold grain through the winter and sell into the spring recovery, had generated revenue that was, on average, 23% higher than the forward contract strategy when measured by net return per acre after accounting for all costs, risks, and opportunities. This was not a fluke. It was the result of a strategy that Carl Obermeyer had developed in the 1930s, refined over 4 decades, and passed to his son in 1967 with the construction of 4 wooden bins, created of 1, and the instruction that storage is freedom. Phil Garrison did not hear about Frank Obermeyer's results until June 2013, when a mutual acquaintance mentioned them at a Champaign County Farm Bureau meeting. Phil was surprised, then skeptical, then, when he ran the numbers himself using publicly available price data, genuinely curious. He called Frank in early July and asked if he could visit the farm to discuss how the 2012 marketing year had played out. Frank agreed, and Phil drove out on a Thursday afternoon in mid-July, the kind of perfect summer day when central Illinois looks exactly the way people imagine it should look. Green fields, blue sky, the air thick with heat and humidity, and the smell of growing corn. They sat at the same kitchen table where Carl Obermeyer had explained supply and demand curves to his son in 1955. Frank made coffee. Phil brought a laptop with a spreadsheet he had built to model the financial outcomes of different marketing strategies across the 2012 to 2013 crop year. "I want to understand how you did it," Phil said. "Not why you think forward contracting is wrong. I have heard that argument before, and I do not agree with it in principle. But I want to understand the mechanics of your decision. What were you seeing in the market that made you confident prices would recover?" Frank Obermeyer looked at Phil for a long moment, then said something that Phil would remember for the rest of his career. "I was not confident prices would recover. I do not predict prices. I do not try to time the market. What I do is refuse to let the market time me." Phil asked him to explain. "When you sold forward contracts for those 23 farms," Frank said, "you were helping them lock in a price. That is what you call it, right, locking in. But what you were really doing was locking them into a date. They had to sell when the contract said sell, at harvest, whether that was the best time to sell or not. They gave up control of timing in exchange for certainty of price. That is the entire point of hedging," Phil said. "You trade upside opportunity for downside protection." "Correct," Frank said. "But what if the upside opportunity is bigger than the downside risk? What if the panic-driven spike at harvest is followed by a slower, steadier recovery that lasts 6 months? If you have already sold at harvest, you cannot participate in that recovery. You are out. You got your locked-in price, and that is the end of the conversation." Phil nodded slowly. "But you did not know there would be a recovery." "No," Frank said. "I did not know. But I knew 2 things. First, I knew that markets overreact, and the August 2012 spike looked like an overreaction to me. It was driven by fear, not by arithmetic. Second, I knew that I had storage capacity. As long as I could hold my grain without financial distress, I did not have to sell at harvest. I could wait and see what the market did over the next 6 months. If prices kept falling, I would sell and take the loss. If prices recovered, I would sell into the recovery. The storage gave me the option to choose." "But you paid for that option," Phil said. "Storage costs money." "It does," Frank agreed. "About 23 cents a bushel per month, in my case. But that cost bought me flexibility. And in 2012, flexibility was worth more than certainty." Phil spent the next hour walking through Frank's decision process month by month. Why he had not sold in November, why he had not sold in January, why he had started selling in March. The logic was consistent. Frank had been watching old crop basis, ethanol production reports, and export data. He was not trying to pick the top. He was waiting for signals that demand was strengthening and that the supply panic had faded. When those signals appeared in March, he started selling. When basis strengthened in May, he sold the rest. What if basis had not strengthened? Phil asked. What if prices had kept falling? Then I would have sold at a lower price than the forward contracts, Frank said. But I would have made that decision with more information than I had in August 2012. That is the value of storage. It is not that you always win. It is that you get to make your decision later, when you know more. Phil Garrison left the Obermeyer farm that afternoon with 14 pages of handwritten notes and a conceptual framework that would reshape his understanding of commodity risk management. Frank Obermeyer's strategy was not anti-hedging. It was anti-premature commitment. It was a recognition that in agricultural markets, where supply shocks are common and price volatility is high, the ability to delay a decision until more information is available has quantifiable economic value, and that value can be captured by farmers who have the storage capacity, the financial stability, and the psychological discipline to wait. Over the following year, Phil Garrison wrote a 30-page case study analyzing the 2012 Champaign County corn market, comparing the financial outcomes of forward contracting versus physical storage strategies. The case study was not critical of hedging. Phil still believed hedging had a place in farm risk management, but it demonstrated, with detailed financial modeling, that physical storage combined with patient, informed selling could generate superior returns in years when market panic drove prices to unsustainable levels. Phil submitted the case study to the Journal of Agricultural and Resource Economics, where it was rejected. The reviewers considered it too descriptive and not sufficiently theoretical. He submitted it to Choices magazine, where it was accepted and published in the fourth quarter of 2014 under the title Storage as a Marketing Strategy: Evidence from the 2012 Illinois Corn Market. A professor at Harvard Business School named Elena Marquez read the Choices article in early 2015. She contacted Phil, then contacted Frank. By 2016, the Obermeyer case had been incorporated into Harvard Business School's Agricultural Commodity Risk Management course as an example of how physical asset strategies can outperform financial derivative strategies under specific market conditions. The case study is titled The Grain Bin and the Futures Contract: Physical Storage in Volatile Markets, and is taught alongside traditional hedging cases to illustrate the range of risk management tools available to commodity producers. Frank Obermeyer was invited to guest lecture at Harvard in April 2017. He declined. 79 years old, he did not enjoy air travel and had no interest in speaking to business school students. But he allowed Professor Marquez to film a 1-hour interview in his kitchen, sitting at the same table where Carl Obermeyer had explained supply and demand curves to his son in 1955, and that interview is now part of the Harvard case materials. In the interview, Frank is asked what advice he would give to young farmers about commodity marketing. His answer is brief and precise: build storage before you build anything else. Storage is not infrastructure. Storage is freedom. When you have storage, the market cannot force you to sell at its convenience. You sell at your convenience, when the price is right, and if you do not know what the right price is, wait until you do. Patience is a skill. It can be learned, but it can only be practiced if you have storage. By 2024, the Obermeyer farm is operated by Frank's son Daniel, who is 53 years old. The original 4 wooden bins built in 1967 are still in use, though they have been supplemented by 2 additional steel bins installed in 2019, bringing total storage capacity to 240,000 bushels. The wooden bins have been retrofitted with modern ventilation fans and temperature monitoring systems, but the fundamental design, conical roofs, gravity flow, and natural aeration remains unchanged. Daniel Obermeyer continues his grandfather's and father's marketing strategy. He does not sell forward contracts. He stores his corn through the winter and sells it when basis strengthens or when local cash prices reach the level he has calculated he needs. In the 2023 to 2024 marketing year, Daniel held corn until March and sold at a price 18% above the November harvest price. The wooden grain bins built by Carl and Frank Obermeyer in 1967, now 57 years old, have stored 57 consecutive corn harvests. They have never failed. They have never lost grain to moisture, insects, or structural collapse. They have required maintenance, new roofs in 1998, foundation reinforcement in 2011, ventilation upgrades in 2019, but they have never required replacement. The philosophy they represent, that storage is freedom, that patience has value, that markets cannot time you if you refuse to let them, has been passed from Carl to Frank to Daniel across 3 generations and 96 years. In 2012, when Champaign County, Illinois, faced the worst drought in a generation and nearly every farmer locked in forward contracts to protect against falling prices, Frank Obermeyer refused to sell. He waited through the autumn, through the winter, through the spring, until the market recovered and the price was right. And when he sold in May 2013, he captured 23% more revenue per bushel than the farmers who had sold at harvest. The grain bin, as Carl Obermeyer said in 1955, is a bank with no interest rate and no possibility of bankruptcy. It is also, as Phil Garrison wrote in 2014, a strategic asset whose value is measured not in dollars per bushel of storage capacity, but in the freedom it provides to make marketing decisions on your own terms, in your own time, when you have the information you need. The 2012 drought taught Champaign County, Illinois, many lessons. But for the farmers who learned it from Frank Obermeyer, the most valuable lesson was this: when the market panics, the farmer with storage does not have to panic with it.